silver didn't just go up, it lost its mind. And now one veteran risk manager says something most silver bulls don't want to hear. Silver had the best year of any major commodity, beat stocks by a mile, and went vertical into year-end. Everyone has a reason for why it has to keep going higher. But today we're looking at a very different take, not from a YouTube influencer, not from a hype trader, but from a man whose entire career has been about spotting risk before things break. His conclusion might surprise you, and if he's even partly right, this market could get very uncomfortable very fast. Let's start with who's making this call, because that matters. Brett Friedman isn't a Twitter account chasing clicks. He's the managing partner at Winhall Risk Analytics, a contributor at Option Metrics, and someone who's spent over 30 years inside the machinery of financial markets. He's built multiple risk management organizations, helped launch trading firms, and worked hands-on across exchanges and over-the-counter markets. This is a guy who lives and breathes volatility, probabilities, and what happens when markets stop behaving normally. And that's exactly why his recent take on silver hits differently. Friedman recently made a simple observation. Silver didn't just have a good year in 2025, it had a historic one. Silver finished the year up 142%. That's not a typo. Platinum and palladium were the only other commodities, even in the same universe, up 127% and 77%. Gold, which most people thought was the star, was only up 65%. Put another way, silver returned roughly 8 times what the S&P 500 did that year. That kind of performance doesn't happen quietly. Retail money noticed, momentum traders noticed, social media noticed, and that's where Friedman starts to get uncomfortable. Then came the final days of the year, and this is where things crossed, from strong bull market into something else entirely. Between December 26th and December 31st, silver didn't just rise, it exploded. One day up 8%, the next day down 9%, then up more than 10%, then down over 9%. 4 trading days that looked more like a meme stock than a centuries-old metal. At the same time, implied volatility, basically the market's fear gauge, blew out to nearly 64%. That was more than 9 percentage points higher than it had been just 4 days earlier. To put that in context, silver almost never trades with volatility that high, and when it does, it usually doesn't last long. After all of that chaos, silver closed the year at $70.59. That's up 46% in just over 2 months. Now here's where most silver coverage stops. People point to inflation, debt, central banks, industrial demand, geopolitics, and say, see, this makes sense. And Friedman agrees up to a point. Yes, inflation is still a problem. Yes, the dollar has been under pressure. Yes, central banks are buying metals. Yes, industrial demand for silver is real. And yes, there's a growing belief that the world is slowly backing away from the U.S. dollar as the sole reserve currency. None of that is new. Those forces have been in play since precious metals started running back in 2024. So Friedman asks the uncomfortable question. If these fundamentals have been there for years, why did silver suddenly go parabolic now? That's where the bubble discussion begins. Calling something a bubble is dangerous. Friedman is very clear about that. Not every fast-moving bull market is a bubble, and confusing the two can cost you a lot of money. He reminds readers that just a year earlier, people were calling AI private credit and even gold obvious bubbles. And yet, none of them collapsed in dramatic fashion. Some pulled back, some chopped sideways, some went higher. True bubbles are rare. And most of the time, you only know for sure after they pop. But, and this is a big but, Friedman says silver is starting to smell like one. Not because the long-term story is fake, not because silver is useless, but because market behavior has shifted in a way that historically shows up near the end of extreme moves. Friedman lays out 3 main warning signs. None of them are opinions. They're all based on data. The first is attention. Bubbles don't just happen in price, they happen in conversation. When something turns into a bubble, it starts to dominate the information ecosystem. It's everywhere. Search engines, social media, casual conversations. People who never cared before suddenly care a lot. Google Trends shows that search interest for the word silver has hit an all-time high, higher than during past bull runs, higher than during previous crises. And recent political events, especially in places like Venezuela, only poured fuel on the fire. This matters because it signals who is buying. When new money comes from investors who don't normally trade precious metals, it tends to be momentum money. They're not there because they studied silver supply chains or refinery bottlenecks. They're there because the chart went up fast. And momentum investors are great on the way up, but they don't hang around when volatility turns against them. Silver is also less familiar to the average investor than gold. People understand gold emotionally. Silver, not so much. That means when prices start swinging wildly, the exit doors get crowded fast. The second warning sign is volatility itself. Late-stage bubbles don't move smoothly. They lurch. Prices accelerate, then snap back, then surge again. Friedman calls this the blow-off phase. Since December 26th, silver posted daily moves of plus or minus 7% on 5 out of 6 trading days. That's insane by historical standards. Going back to 2005, that kind of daily move has happened only about 1.2% of the time. Moves bigger than 7%? Just 20 days total, less than 0.5%. Implied volatility tells the same story. Silver volatility above 60% has occurred only about 2.2% of the time, historically, and when it does, it typically lasts less than 2 weeks. Markets can stay crazy longer than you expect, but they don't stay this crazy forever. The third signal comes from a very old, very boring metric, the gold to silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. When the ratio falls, silver is outperforming gold. Since April 2025, that ratio has been collapsing. In the 20 trading days leading up to December 26th, it dropped nearly 25%. That's the steepest percentage decline since 2005. When ratios move that fast, it often means one of two things. Either silver is wildly undervalued, or it's overshooting in a frenzy. Given everything else happening at the same time, Friedman leans toward the second explanation. Here's the key moment, and this is where Friedman's experience really shows. Even after laying out all these bubble-like signals, he does not say to short silver aggressively. He does not say to stand in front of the market and call the top. He doesn't say silver is going back to zero. Instead, he offers a warning that only someone who's seen markets break can give. If silver is in a bubble, you will not miss it when it turns. Bubbles don't end quietly. They don't roll over slowly while everyone calmly exits. They end with violent moves, failed rebounds, and clear changes in behavior. Trying to fight a freight train just because you think it's going too fast is how traders get flattened. If and when this move exhausts itself, there will be plenty of opportunity to trade it on the other side. That's the part most people miss. This isn't about being bullish or bearish. It's about recognizing when risk is no longer priced normally. Silver may still go higher. It may overshoot even more. But the margin for error is shrinking, and the emotional temperature of the market is rising fast. So where does that leave us? Silver just had one of the most explosive years in commodity history. The fundamentals everyone points to are real inflation, debt, industrial demand, currency, stress. None of that disappears overnight. But markets don't move on fundamentals alone. They move on positioning, psychology, and flow. And right now, silver is flashing the same signals that show up near the end of extreme runs. Massive attention, violent volatility, and historic ratio moves. Brett Friedman isn't saying silver is dead. He's saying risk has changed. And ignoring that because you're emotionally invested in the trade is how bubbles do the most damage. The real question isn't whether silver can go higher. It's whether you're prepared for what happens if it doesn't. If you have insights or questions on today's analysis, leave them in the comments. Your input helps shape the direction of this channel. And if you want to stay ahead of the major moves in the metal markets, make sure you like the video, subscribe, and turn on notifications so you never miss a critical update.